From the morning reading, small caps lead on pause day that rises. 7 and 9 sectors moved higher on Wednesday. XLE, XLF, and XLU were the strongest sectors, while XLU was the weakest sector. Oil futures rise 84 cents to close at $34.73. Breadth weakened as advancers led decliners 2.02 to 1 on the New York Stock Exchange and 1.93 to 1 on the NASDAQ. And this has not been a weak rally. We've already shown last week that volume doesn't matter. Using 3 breadth measures as a gauge of strength, this has been the 5th strongest out of 26 total since 1957. This matters because stronger rallies have had a tendency to persist in the weeks ahead than have weaker rallies. In May 2008, we looked at the average bear market rallies. In May 2008, we looked at average bear market rallies and determined we were about at the limit. Updating those figures now, the current rally is well below average in terms of duration and below average in magnitude, though it's about average when looking at the retracement of the prior decline. Also, medium-term optimism is below 50, which was not the case at any other peak since 2000. If we assume that beginning of month returns are influenced by mutual fund flows, we might assume that funds are experiencing or expecting an influx of funds. It's a dubious conclusion, but whatever the reason, stocks have surged more than 2% to begin the month. There have been 17 other times that the S&P jumped 2% or more in the first 2 days of a month, when it had set a 52-week low in the prior month. Over the next 10 days, it added to the gains only 35% of the time, averaging a minus 0.9%, but it ended the month with a gain of 76% of the time, averaging 3.7%, suggesting shorter-term weakness was usually just temporary. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:47 a.m. Central Time, and I'm recording this in preparation for the market day of March the 3rd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And activity last night is pretty much benign. On the 4 U.S. stock market indices, you have the S&P basically at scratch, and the Russell is up less than 0.5%. The NASDAQ and the Dow are also at scratch. Crude oil also at scratch. Euro's up about 0.25%. Bonds at scratch. Gold just above scratch. And China and the other foreign markets that we track, a little bit more activity, but still relatively quiet. China is up about 0.33%, Hong Kong down about 0.33%, Japan up about 1.25% for the biggest mover of the night. Germany, the market that we have the closest correlation to generally, is also about scratch. United Kingdom up about 1/3. In terms of macroeconomic reports for today, we had the weekly version of the unemployment claims, revised non-farm productivity. Let's see here. ISM non-manufacturing after the market opens, and factory orders. And then also for you nat gas futures traders, the nat gas storage report is out today. In terms of looking forward, we have the big one. This is one of the big 4 reports, non-farm employment change. So that's your monthly employment reports. And trade balance. You also have trade balance, and that's all before the market opens tomorrow. So once the market's open, you won't have to worry about anything else coming in from the macroeconomic report side for tomorrow. In terms of current volatility conditions, look at this. Short-term VIX down below a 16 at a 15.78. Skew a little bit up, but still below the warning threshold, so relatively benign. IV percentile on the S&P is at 23, 22 on the Russell, 25 on the NASDAQ, 21 on the Dow. So these are all very, very low. In fact, in the lower 25 percentile. And in terms of standard deviation moves on a close-to-close basis yesterday, only the Russell was up 1 standard deviation move. And let's go ahead and go to the charts. Now let's go ahead and start with the Russell today. So this is futures, so this reflects the overnight activity, and you see it was the one that had a little bit of movement. But notice how these candles, after we've broken out through the resistance area, we had the big breakout, but then now the next candle's a little smaller, and of course we're just a partial day here. But we seem to be starting to run out of energy and momentum on this most recent rally. Now, obviously, anything could come in and give this new energy, but left to its own, it would seem that we've got the early signs that this rally may be starting to run out of steam and may be setting up for a retracement. Notice also the Russell's still in the cloud. It's still facing a good bit of resistance in this area. And let's go ahead and go to the NASDAQ. And you see very much this same kind of effect in the NASDAQ. We broke through the area of resistance, had a very nice big candle, confirmed close, but then that was followed by we'll call it a spinning top, right at the top of the cloud. And then so far the action today is also a doji. So this would seem to be setting up for a potential short-term pullback. Now, we're not expecting anything large at this point. It's probably a typical bull flag pattern, but this has been an important development in breaking through this area of resistance. There's still a lot more overhead resistance, especially if you start drawing various triangle and wedge patterns and longer-term patterns. There's a lot of things that are coming into play at this point, and that will probably start to be some stiffening resistance. Not to say that the short-term pattern, and to an increasing degree, perhaps even the intermediate-term pattern, isn't still have a bullish bias. It probably should, yet at the same time, we're starting to run out of some strength. And the Dow, you see it cleared a very important area, and it's definitely been the strongest. We've had a higher high, higher low, higher high, higher low, higher high, higher low, now higher high. So this has been in a very clear intermediate term pattern of being in a bull posture. And it's also cleared important resistance areas and cleared the cloud, all representative of significant resistance. And in fact, you'd start to get to the place where, you know, the cloud people are calling this a Chicago cloud breakout. And, you know, these are signals for people to take long positions when you see these kinds of things coming together. And then most importantly, let's take a look at the S&P. And you see the clearance of the important resistance zone, the clearance of the cloud, and also, you know, much like the Dow, this kind of Chicago cloud breakout. But also note the candles seem to be starting to get smaller. We seem to be running out of strength, at least on this current up leg. We probably need to digest some of this momentum with a little bit of a pullback, and that we would pull back to the top of the resistance area, the top of the cloud, would not be a bit surprising, and that would be right around the 1950 or so area. Would not be a bit surprised to get a little bit of a pullback. Not expecting at this time anything more. Let's take a look at bonds. And bonds also would be seeming to say that we could get a little bit of a reversal in the broad market. It also has a reversal pattern in play and is kind of setting up to say just the same. Gold also is, unlike some of the other markets, we would expect that gold would have pulled back, but it's continued to hold its strength. And in fact, we've got something of a ascending triangle forming here, where you have basically a flat top and a diagonal support line coming across, and you would expect that this is about ready to break. And if you don't already have a gold position, stalking a momentum price action entry off of the tops of these patterns right here, perhaps at about 1250. Would not be a bad thing to do in terms of probability setups. That would be likely expected to take another leg up, and that's a pretty sweet setup right there. Classic consolidation continuation pattern, and it's very close, it would seem, to breaking out within the next few days. We're about to get to what would be called the apex of this ascending triangle position. So gold moving up would also seem to say expect that the markets probably are going down. You saw the same thing with the bond market, saying that the expectation is that the equities could pull back here shortly. So I think that's probably enough on the charts for today. Let's go ahead and go to our daily report. We continue to see things slowly but surely improve on the daily report. And I heard a phrase yesterday, and I really liked it, so I incorporated it in here, that this is a market first principle opinion. And ultimately, what that's saying to you is that we trade around an awareness of what the market posture and hedge risk levels are each and every day. And this whole exercise around this daily report is just that. We're trying to align the probabilities, give ourselves an edge by layering in positions or taking off positions or making hedging activities directly related to a market first principle. While the individual signals from individual symbols is important, it's nowhere near as important as what the market is doing in the big picture, because that probably represents about 70 to 80% of the movement in an individual stock, and we really do not want to fight that kind of tide and have the any kind of thing going against our trading edge. So in the intermediate term phase opinion, the market trend is a phase 4, very bullish pattern, price patterns near horizontal resistance, confirmed uptrend from IBD in their portfolio posture. Accumulation distribution score on the NASDAQ is a D, on the S&P improved to a D+. GMI index also improved. It's still in a sell signal, and it's been there since 1210, but it has improved to a 4 out of 6, and this author has started to take some positions, has been largely in cash for the last 2+ months, but is starting to take some positions. So of some note right there. Decision point scoreboard, no changes as of yet. We're waiting to see, does this short term in contrast to a long term, start to actually form bullish patterns and confirm that in the intermediate term. That has not yet happened yet. We have some neutral patterns, but not bullish patterns on that system. Getting much closer, obviously, to being able to flip that over. The reason that's important is, as long as we've got short-term bullish against long-term bearish, this is expected to be something of a bearish pattern and counter-trend trade, and would be expected to kind of give up the ghost until proven otherwise. So we're looking to see, does this market prove otherwise and start turning these intermediate into bullish signals, or does the short-term bounce off the long-term bear prove correct that this is just a counter trend trade and that we're going back down to the bottom? In terms of position sizing opinions, the two systems, portfolio investors at 100%, volatility system is at 75%. The intermediate term market posture, as you can see, is very strongly bullish with a weak bullish sentiment line. So look at these, 94, 94, even the Russell now up over 90, and the NASDAQ, which is also up over 80 and very strongly bullish, is the weakest of the four, but played a lot of catch up in recent days. In terms of the strength of the trend, we are a very, very weak intermediate term bull trend, so kind of keep that in mind. The market sentiment line that we had up here, based on the daily candles, was very weak bullish, so that certainly would seem to confirm that as well. Hedge risk status is currently at a 0+. This is normal with some elevated risk conditions, and we certainly agree with that synopsis. In terms of special opinions, option income strategies of VIX is a borderline acceptable. So we can initiate new positions for option income strategies for novice traders, but consider reduced position size. The VIX is still, on the VIX Futures, just over 18, and we would expect that there could be somewhat larger than normal volatility and delta moves. We might have to have more adjustments than is average when we're trading in a 12 to 18 market environment. But that's been largely coming down. And even for novice traders, we're about to enter into what we would consider normal trading conditions. In terms of covered calls and put selling, no changes from yesterday. Conditions are acceptable for new positions for novice traders. Of course, there's a number of suggestions here of how to still construct this, whether you're doing covered calls or you're doing put selling, how to make some adjustments to your patterns so that you are more defensive than perhaps all out bull. And remember, up here we are not yet all out bull. The consensus of this area is that we're still a market in transition. We do not have the times stacked, and we do have contrary signals still in place. So you should not be just doing out of the money covered calls. This market does not yet support that, but at the same time it does support you having additional bullish exposure. In terms of specific warnings, really the only thing left is this VIX Futures up over 18. The regular VIX is actually below 18 at this point, I believe. I'm looking real quick, see if I can find that. Let's see. Yeah, 17.09. VIX Futures are still up over 18. We prefer that for our signal. The VIX Futures gives, we think, a truer signal in the way it rotates from one contract to another. In terms of new highs, new lows, look at that, more than twice the threshold to consider this a bullish sign. All 5 of the key intermarket risk aversion indicators are risk on. In terms of sentiment, we are getting relatively extended in terms of sentiment. So from a warning status, we do have a short-term risk warning on stocks, a mild warning on bonds and gold from a sentiment standpoint, certainly not yet very extreme. Also look for potential reversal patterns in these symbols right here. Sentiment here is all climbing, and so particularly retail, high yield bonds, housing, those are all up over 80. And could be setting up for a bit of a digestion and pullback at any time based on a sentiment reading. Also from sentiment, we had the fear and greed index, and notice that we have gone all the way to a 66 now. We've made up a lot of room in the last 2.5 weeks now, and we're now up into the greed category. In terms of sector-specific information, we have from decision points, the intermediate term market postures being supported by the equal weight materials, industrials, consumer staples, gold, utilities, and the TLT, the long bond. This is starting to see more of this higher beta areas come into the intermediate term bullish postures, joining many of these more defensive plays. So kind of be recognizing the change. We've been talking a lot in recent days about that the institutions were buying defensive positions, but we're starting to see a little bit more of a blend in that. And indeed, when we go to the sector specific, you notice that yes, it is telecom, yes, it is consumer staples, and yes, it is certainly has been utilities, though that's given back a little bit of late. And where is it giving it back to? Well, we're starting to see consumer discretionary, and we're starting to see retail and technology also come into play. So the money is starting to spread out, not just defensive sectors, but also now in some of those higher beta areas. And indeed, yesterday, you see, look at the financials. and energy and information technology, industrials. These are wildly positive, but still they're positive. And we're starting to see a situation where this is a more blended market. So that's a nuance there that you need to key in on. So I think that's probably enough for today. We're right at 20 minutes. So we're going to go ahead and just scroll through this wrap up section. If you see anything of interest, just get to the hyperlink, go to that, get the details that you need. You can, of course, pause the video at any one of these slides to get the information that you need. We greatly appreciate you liking us on YouTube and retweeting us to your Twitter followers, to your StockTwit followers. That's the way you pay us for our time and effort in providing this to the community each morning. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you notice the hyperlink there to take you to the full set of disclosures. We'll see you back here on tomorrow morning with the Falcon Global Market Preview. Good trading.